Okay. So apologies for that. There was an issue with the stream latency. Apologies. So let's go through the interest rate, not the interest rate prep, the PPI prep then for the US session. So you should be able to hear me okay. Okay. Right. So US PPI, what is it? Let's have a little look. So PPI, it shows the price, a change in price of goods sold by producers, and it can be an indicator or leading indicator for CPI, the Consumer Price Index, crude goods. So what does it include, or what does the PPI include? So it includes crude goods such as wheat, cattle, soybeans, coal, crude, sand, and timber. And then you have the intermediate goods that are included, such as flour, animal feed, auto parts, and fabric. And then finished goods such as furniture, automobiles, meat, gasoline, and fuel oil. So if we get inflation at that stage where finished goods are seeing a high amount of inflation from the producer side, then that could be quite serious for the US economy, where the prices for the finished goods could be passed on to consumers as well. If you are just joining, do let me know where you're joining from. I know we started a little bit later. Apologies again for the issues with the stream. But if you give me a little hello, where are we joining in from? If we put it in the chat, and we'll go from there. Okay, so food and energy makes up 40% of the finished PPI report. So that's quite a significant amount that we get from the report there. Particularly, of course, we have the current risk that we have with the oil markets facing from the Ukraine situation, Iran potentially coming back to the market with the nuclear deal on the precipice of being created or being finalized. So there's those bits of risk. Quick scalping says from India. Hello, welcome along. Okay, so the first, and it's also the first inflation report out every month. So this is the data that we get before the consumer price index comes out later on in the month. Is everyone so far kind of clear? And I'm kind of going through it quickly, conscious of the time we started with the stream as well. But is everyone all good with that so far? And then we'll move on. Quick scalping, you're good with that? Remember, there will be a recorded. This is being recorded, so you will be able to watch. You will be able to watch it back as well later on after this live stream is completed. Okay, so let's move on then. So previous report. Now, previous report we had. We'd seen that prices paid to US producers jumped in January by more than forecasted, pointed to persistent inflationary pressures as companies contend with supply chain and labor constraints. And the gain from December was the largest in 8 months. So just showing here from the Bureau of Labor Statistics, we can see that producer price inflation remained extremely elevated in January. So this month we'll be getting the February report for producer price of the producer price index. But as we can see here from 2020, where producer prices had dropped off when there weren't a lot of companies or these producers making goods, and then we had seen a huge drop off. But as we started to recover from the pandemic, then the producer price index started to rise and then move back to towards this point, or get to this point where inflation for producers is running quite hot. And we'll go through some of what the Fed members have said and what that also means for the economy as well overall. So that was the previous report from last month for the January data that we had received. So if we go on to the Fed's view then, so you had Fed members such as Fed's Mester saying that there's a likelihood that substantial increase in energy prices as well as supply chain issues will persist for a longer period of time. increasing the risk of high inflation becoming entrenched in the US. So remember, as I said with PPI, if the producer price index means sees higher inflation continuously or consecutively, then what that could mean that for those companies that buy the goods from those producers, that could be passed on to consumers. And if that is passed on to consumers, then of course that means consumers are paying more for the goods that they receive from those businesses. Usually, in normal circumstances, when you don't have such a volatile, so let's say, commodities market, what usually happens is the PPI is usually quite steady. So what that would mean is that those companies buying those goods don't always increase the prices for consumers if the economic situation is stable. But at the moment, first of all, we've got the rate hike to contend with for tomorrow. We've also got hot inflation, the highest in 40 years. And then we also have a very tight labor market alongside with producers and the manufacturing sector running quite hot as well. So there are those different elements to contend with that we've got to be aware of for the PPI report. And as we can see here, for the CPI and PPI from Japan compared to the US, you can see that with the PPI data, that the CPI here for the US is catching up. So recent commodities rise will reflect in upcoming PPI data. Yes, so that's one thing that I wanted to kind of go through as well. That with the whipsawing or the volatile energy market that we can see, then that's going to be, of course, for the energy side, that could factor into the report that we get for February. But as we can see here, so this shows you how the producer price index is compared to the CPI index. And if you see the PPI index moving in, or if you see the CPI index moving in line with the PPI index, as we can see for the US with their PPI, CPI here and their PPI there, then that spells some negativity that spells a very hot inflation environment for that economy. Compared to Japan, we can see so even though Japan's PPI is quite high at 9.3%, we can see that a lot of those prices that are being paid by those producers and the businesses buying from them isn't being passed on a lot, or isn't being passed on really to consumers. Now, generally, consumer prices in Japan are not really that strong. The reason being is that there's not really a lot of buying compared to the US. If we compare if we have a look at that comparison, and we can clearly see that here, that because even though PPI is quite high, that doesn't really translate so well into CPI, or doesn't marry so well with the CPI data in Japan. Whereas in the US, that's a different story altogether. So I think with the PPI, that also plays a part as well. As we've also said that we've had Fed's Powell saying that in the short term, getting past supply chain issues would help with inflation. So any further disruption or any further increases to PPI would factor in to the Fed's view on trying to ease or trying to help with those supply chain issues, i.e. by trying to bring down inflation overall with hiking rates. Okay, so other bits of information that we need to be aware of as well. So the IHS market manufacturing data that we had received for the February report, or in February, said that there is a less fear. This is bearing in mind before the Ukraine conflict had begun, whereas IHS had said that less severe supply chain disruptions led to a slower increase in input prices, and the rate of cost inflation eased to the softest in 9 months, but remained historically elevated amid higher material and transportation fees, according to the report. So and I've got a little repeat there. So before the Ukraine conflict, there was the disruptions were slowly eroding away, and the PPI, or let's say the input prices, what we had seen, were actually starting to come back under control to a degree. Which, of course, if those input prices are coming back under control, that means those producers of those goods are able to produce more in a less expensive way. So there's that factor to kind of to consider when we're thinking about PPI and where producers are at the moment. So before the Ukraine conflict, that's what we had from the previous market data. And then also just to bear in mind, I want to have a look at the IHS market manufacturing report as well. So if we take a look at the prices paid, go back up. Okay, so even in the prior report that we had for the ISM, the report that we had seen, so that registered 75.6%. So there was a decrease in the prices being paid, although it was the 21st consecutive month of price increases overall. So, but it was at a slightly slower rate in February. Now, with the Ukraine conflict, we'll see how much that causes the PPI to affect the manufacturing sector and the economy overall. Bear in mind, this report for the ISM measures the US in its entirety. So in particular, what we can see is, so you've got particular areas where prices were still increasing, but not as quick as a rate as the prior month. So you can see here, so what we've seen is that petroleum products, vegetable oils, lumber and paper products, aluminium and stainless steel had remained at elevated prices. So again, there's strong price pressures that are there within the market at the moment. So aside from the ISM report from the Institute of Supply Management, let's go back. So we want to have a look at the sentiment then of what investment banks and markets are considering as well. So you had Deutsche Bank yesterday saying that economists say there's a growing risk that Powell could feel great pressure to lift rates to levels that ultimately tip the economy into a recession, adding it's a very difficult path for the Fed to guide inflation back to target without triggering a downturn, and the path got even narrower with this latest supply side shock that we're seeing. And that was according to chief US economist for Deutsche Bank, Lazzetti. So again, the Ukraine conflict is adding to the negative or the bearish sentiment for producers, and how the markets are and how the Fed, although the Fed didn't really go into a lot of detail about the Ukraine issue, and they said they're more of in a wait and see sort of mode to see what kind of impact that has on the US economy. We haven't seen that so far yet from the data that we've received. So we'll see how the markets react to today. But looking at the markets, we've got to bear in mind at the beginning of the Ukraine conflict, we'd seen treasuries that had rallied. So that's the price of treasuries after the Russian invasion of Ukraine, amid a rush into the safest assets. So you had a rush into the Dixie, the Swiss franc, the Japanese yen, and we've also seen strong movements in gold and in the commodities, but also in the commodity space, we'd seen a strong movement or strong appreciation in WTI crude oil or crude oil overall. Then we had last week where the pendulum swung back just as swiftly, with a 2-year yield surging more than two year highs as a steep jump in consumer prices underscored the case for the interest rate hikes the Fed is almost certain to begin tomorrow. So you have a mix of sentiment. So you have the sentiment of the Russia-Ukraine situation affecting indexes, where any negative news or positive news is going to cause huge swings in the markets, where we see either risk on or risk off reaction. And then you have from the central bank side, or what central banks are doing in regards to tightening policy, that the Treasury market is seeing a lot of volatility, as where investors are again going into safe haven assets. So they'll go into US securities to protect or hedge against the volatility that we're currently seeing in the market. So for what we can see here, as we can see on the white knuckle ride, is what Bloomberg calls it, that the Treasury market volatility surges. So this is from the Bank of America Move Index, or the ICE Bank of America Move Index. And we can see that prior to going back to the recession, we're getting to around that 250 area. And then during the COVID pandemic, we got to above around the 150 area. And then currently at the moment now as well, with the situation with Ukraine and Russia having a conflict and causing that risk off reaction and people going towards safe haven assets, we're seeing that increased volatility in the Treasury market. Again, a flight to safety also includes US securities. And that's so at the moment for the markets, it's difficult to see which way the market might be going, with these two bits of sentiment colliding together at the same time, causing this extra volatility that we can see in the markets. Okay, so the past reaction we had from the February release. So if we go to our deviations, if I bring that up here, and then we can have a look at the charts as well. So in February, in regards to triggers, we'd seen about a 0.5 deviation on the month-to-month figure, and the reaction on the initial candle, going from the start of the candle to the top or the low end to the low of the wick, on the S&P 500. We had seen about 42 ticks towards the downside on that initial candle. The dollar yen had seen about 7 pips towards the upside. Euro dollar had seen about 7.5 pips. Cable had seen about 10.5 pips down. Gold about 30 ticks down. Then on the dollar CAD, or on the dollar US CAD dollar, we had seen about 3.5 pips up. So not a strong reaction from the dollar CAD from the figures that we had received there on February 15th. On the US 2-year, bearing in mind that's the bond, not the yield. So on the prices, we had seen about 7 ticks. We had seen about 7 ticks down. And the US 3-year, we had seen about 5 ticks down on the back of that release. And then in January, we had seen the month-to-month data came in slightly worse than expected, about a 0.2 difference on the month-to-month, which is the main headline figure. That is the headline figure that's put out in the report from the BLS. So we've seen about 30 ticks up on the S&P, where we had seen that inflation wasn't as strong as the market was expecting it to be. Reminder, at this time period in January, we already had the Fed saying that they're going to withdraw some of their asset purchases, or start making a drawdown of the asset purchases, and they're expecting for that to end in March. So from there, the market was that if inflation is running hot, then that would have been, as we'd seen in the prior release, that would have been a positive for the US dollar and negative and it would have been bearish for stocks, as that led into the expectation that the Fed is going to raise rates much higher by 50 basis points rather than 25 basis points if we had seen a stronger reaction. if we had seen a stronger PPI figure. So that was February 15th. And again, January 14th, when the producer price index wasn't as strong as expected, or was worse, then we had seen a more of a positive reaction from the markets there. So we had seen about a 4 pip move towards the downside on the dollar yen. Euro dollar had seen about 5 pips down at where it ended. And then GBP and the cable had seen about 6 pips up. So again, excuse me, so euro dollar would have been 5 pips up rather than down. Gold had seen about 11 ticks up as well off the back of that release there. Then back in December, where we've seen about, it was 0.3% deviation from the forecast figure or the median estimate. It wasn't as, there was a reaction, but it wasn't as strong from the markets as we had seen. So there's about it's about 25 ticks down on the S&P, or 4.5 ticks up on the dollar yen, 3.5 ticks down on the euro dollar, and on cable about 2 pips down, 3.5 pips down, and 4.5 pips up for the dollar yen, and 3.5 pips down for the euro dollar. And for cable, we'd seen about 2 pips down. Gold had seen an initial move towards the downside, about 9 ticks, and then we'd seen that move back towards the upside for a total of about 13 ticks altogether on that first candle. So what we're looking for, if we go through the estimates and triggers then for what we've got to be aware of. So the month-to-month, the high estimate, we're looking for about a 0.5 deviation there. So if we go to, let's look at the current forecast that we have for the PPI data. So hopefully you guys can see that there from what we can see here. So for PPI month-on-month forecast is 0.9% with a prior 1%. PPI year-on-year forecast is 10% with a prior of 9.7%. Core PPI year-on-year forecast of 8.7% with a prior of 8.3%. And core PPI month-on-month with a forecast of 0.6% with a prior of 0.8%. So the key release that we're looking for is the PPI month-on-month. Now remember, in this current circumstance where inflation is a key topic for not only the Federal Reserve and central banks in total, we've also got to be aware of particularly in the US, as said, the reason why we're looking at this report today is the volatility that the PPI report and moves that the PPI report can create. Hence why we've seen the particular deviations here. Although these reactions didn't last long, there was that initial move that we had seen that was quite strong from the markets. So going back to the triggers then, the triggers that we have for the month-to-month, highest estimate of 1.4%, so about 0.5 deviation with a low of 0.5%. So that's, as I said, a key figure that we're looking for. The year-on-year highest estimate is 10.4% with a low estimate of 9.6%. Bearing in mind, we've also got some economist data, or this is from an economist survey that we're looking through here as well. So core month-on-month with a high estimate of 0.9% and a low of 0.3%, and core year-on-year with a high of 9% and with a low of 8.2%. So those are your triggers there. We've got about three minutes until we get the PPI release. But overall, with this current sentiment that we have of the markets, keeping an eye on inflation and where the Federal Reserve and other central banks as well could take that into account, that could lead to a stronger rate hike, or that could lead to a bigger amount in rate hikes. But we'll have to, so what that could mean for the dollar, usually that would appreciate in value. And in this current circumstance, from what we've seen previously, the S&P had weakened, and gold had seen a weakening as well. And US bonds had also seen some weakening as well. So if we do get that, if we do see that figure coming in above 0.5 deviation from the forecast, and 1.4% for the PPI month-to-month, we could see that strong we could see that positive reaction for the dollar, which could be strong. Okay. But as said previously, we had seen where we had that reaction for the PPI, and then we had seen. So we'd seen that initial move towards the downside on other currencies against the dollar, and then a reversal of that data there. So again, we'll wait to see what sort of reaction we get today as well. But we have less than a minute remaining. We have about less than 2 minutes. So let's get the figures. Let's get it up here. Let's get our charts here. Hopefully you guys can all see the charts so far. They're nice and clearly. Got less than a minute now. Okay. All right. Okay. 10 seconds to go. Seeing my Fed coming in, PPI month on month coming in slightly worse than expected, at 0.8%, lower than the forecast of 0.9%. So seeing what we can see here, so we're seeing the S&P 500 seeing that movement towards the upside there, so not as strong as expected from the PPI report. Also, a trigger was for a low of 0.5, but seeing here worse than expected data from PPI, seeing an appreciation on the S&P 500, gold seeing some whipsawing there. Dollar yen, not seeing too much reaction there from the release. We kind of, there we go, a bit better. And the bonds, so this is the 2-year bond that we're looking at the moment. The bond price seeing some appreciation there towards the upside. Okay, let's have a look at some of the other currencies too. So gold did see some movement towards the downside there off of that release. So if we compare that to the prior release that we had previously, what we'd seen when we had a positive PPI report, we'd seen about 30 ticks down when there was a 0.5 deviation from the release. Whereas here, we can see, even when there was about, this is similar to, it's not, again, not strong data from the PPI report. Okay, now seeing some moves towards the downside on the dollar yen. Let's have a look at cable, GBP, USD. Let's go there. Okay, cable not seeing too much of a move there either. So the data not being that strong. I'm also seeing the reaction on the S&P 500. Gold, as said, did see that initial move towards, we'd seen that initial little pop and then move towards the downside. So if we measure the ticks that we can see on here, it's about 65 ticks. So from the start of the candle to the wick of the candle. So we can see about 65 tick movement towards the upside there on the ES. On the S&P 500, if we go back to our dollar yen did see some negative reaction, as said. So if we go, let's see how many pips we got on here. So initial move wasn't as strong. So it looks about about 4 pips towards the downside, or what we can see there on the dollar yen. It's about 4.5, 4.3 pips towards the downside on that initial candle. Again, going from the start of the candle to the wick. Okay, now we're seeing some movement towards the upside on gold. And the bonds, what do we see here? So the bonds, okay, I did see that move towards the upside. So let's go to the bonds. Let's double check. Let's see what we get. Let's see what we had. So 31. It's about 4 ticks towards the upside there on the 2-year bond. And the one price in gold for the initial reaction. And about 33 ticks towards the downside on gold. So if we so about $3 move towards the downside on gold from what we've seen from that release. Okay, so one thing I think is kind of clear for the S&P 500. I think the case being that if PPI inflation were to be stronger than than expected, that would play into the hands of the Federal Reserve, possibly tightening, making for a stronger tightening case, i.e., where they would start to draw down on their balance sheet much quicker, and potentially that could have increased, that could have meant that further down the line we could get a higher rate hike for the meetings coming up. But I think for tomorrow, that doesn't look to be the case. And the PPI report has helped with that, where we're kind of sticking with the Fed, leading with a 25 basis point hike from their side. And considering, I think again, it's kind of supported. I mean, so it's kind of supported the S&P 500 today, where again, it's not as strong, and neither is it as weak as well. Remember, we had a 0.5% deviation that we were looking for on PPI to look for a stronger reaction from the markets overall, but we didn't get that. But even then, we're still seeing the S&P 500 still moving, still seeing some moves, or still hasn't completely erased its initial move towards the upside. So for the S&P 500, this looks to be that, of course, with inflation playing a role, if we do get slightly worse expected figures for the PPI data, then we would see that positive move. Again, not as, but again, sort of about 65 ticks for the S&P 500 there towards the upside. Gold was a mixed reaction. Dollar yen didn't see such a strong reaction from that report. And then for the 2-year, again, didn't see a hugely strong reaction from the report either. Does anyone have any questions? If you're if you're watching us now, quick scalping. Any other questions? Are we all good so far? Okay. All right. So remember, this is being recorded, so we will be able to post a link to the video at the conclusion of this by the end of the day for you to have a look at. Remember, what you can do for users who want to stay up to date with the MacroAce reports and the trade prep that we do provide for you guys. What we'll also do is we'll also post out the link for you guys to be able to join us. So if I just bring that here for you, and I'll pop it in the chat as well. So if we click on this link here, you're able to sign up to our emailing list and be able to stay up to date with what to expect for the rest of the week as well. So what I usually do is I would send out on Sunday night the week ahead prep of the releases that we'll be going over and covering, and then day by day I'll be sending out the towards the end of the US session, I'll be sending out the recorded video of the session that we had held for that day, or the sessions that we had held for that day, of links and a YouTube link we had done, and then I'll be sending you also the live link for the following video, or the following YouTube live stream that we have coming up. Okay, so that link is there for you. Thank you very much for joining us. If you did, I hope you found it useful, and we'll catch you tomorrow we have US retail sales and Canadian inflation data, and then we also have the EI inventories. Then we have the FMC interest rate decision later on in the afternoon of the US session. So it's going to be quite busy tomorrow, and there's going to be a lot going on at the same time. But for now, thank you very much for joining me. This has been your host, Tony from MacroAce. We'll catch you tomorrow. Goodbye.